I want to highlight the advantages of index investing. Just as I earlier spoke about the pitfalls involved in index investing, I want to equally present the advantages, the benefits of index investing. Number one, cost efficiency. Now, the very fact that index funds charge a lower expense ratio compared to actively managed funds, you discover that the funds are able to charge very low fees, and once the fees are kind of reduced, invariably it's going to impact the level of return that investors in these funds are going to get at the end of the day. And so lower fees translate to higher returns. Number two, diversification. A typical index fund is well diversified because they tend to invest, or the constituent companies tends to come from virtually all sectors of the market. The companies involved generally, they tend to represent almost all industries in a typical stock market. So the index fund or index investing is fully kind of diversified. Number three, simplicity. You don't need an MBA to understand index investing. It's very simple. Anybody and everybody can participate. Everybody understand fully what is involved. It simply has to do with buying a broad index. It might be the S&P, it might be the Russell 2000, any index in the market actually. And so it's very simple to understand. You don't need a higher level of financial literacy to understand how an index fund operates. And that simplicity tends to attract, more investors into this area of investing. Number four, consistent performance. A typical index fund tends to perform consistently compared to an actively managed fund. And this is due to the fact that the performance of the index fund actually reflects the performance of the index or the benchmark the index fund is tracking. If the benchmark does very well, performs very well, the index fund will equally follow suit. And their performance actually is consistent compared to what is obtainable amongst actively managed funds. The market doesn't gyrate year in, year out as such. You discover that all things being equal, that return is like smoothing, is smoother than what could be obtainable from an actively managed fund. Number five, passive management. The index fund is passively managed. The managers there don't undertake strenuous, difficult, sophisticated research. They don't really need, sophisticated tools or software or algorithm to invest in the market. No, they simply go in, buy the index, and that is all about index investing. It is passively managed. There's no much activities involved in managing or overseeing an index fund. Number six, reduce risk of underperformance. For the fact that the index fund mirrors the overall performance of the market, you discover that the risk of underperforming the market or risk of underperformance is quite minimal, if not absent at all. When the market does well, the index fund will certainly do well. Except the market doesn't do well, that's the case where the fund will be affected. But if the market, records, level of profitability, the overall market, then of course the fund itself will equally record that level of profitability as well. And so it's not as risky as other forms of other strategies like an actively managed strategy, like the momentum or growth investing. No, it is less risk. The risk involved is actually mitigated. Number seven, transparency. The stocks held by a typical index is known to virtually everybody. They buy the index, and this index actually the constituent stocks are published regularly, and so the investor knows precisely what and what stocks constitute the index he or she is buying. There's that transparency is quite glaring. Everybody could attest to that. Number 8, automatic rebalancing. Rebalancing in an index fund is done almost automatically. When a given stock is dropped from the index, the manager automatically drops that particular stock from the portfolio. And when a new stock is brought into the index, the manager purchases that particular stocks into the portfolio. And so there's that automatic rebalancing. It is done automatically. It is done, in a hitch-free, simplified manner, simplified pattern. And that's a very key characteristic of an index fund that makes the work of the manager very, very easy indeed compared to the actively managed fund. And I would solicit you subscribe to this channel. Please press the notification button and share this video to people around and close to you. And don't forget to make critical comments in the comment section so I can be encouraged to do better and to provide even better content for you hereafter. Number 9, long-term growth potentials. Index funds have a long-term potentials for growth because the market actually don't stagnate for a long time. Once the market starts growing, then definitely the benchmark equally grow as well. And as the benchmark grows, all the funds that target these benchmarks, will equally grow as well. And so the performance of the market, the performance of the market generally affects the performance of the index fund. And as the stock market grows over the years, we all know that the market generally returns about 9% on average every year. And so the index fund manager or the index fund investors are bound to enjoy this level of growth, regular growth that is expected from the markets on a yearly basis. Number 10, ease of access. The index fund is very easy to access. Anybody can buy into an index fund. Simply contact your broker. Your broker can can give you a means, can show you a means of gaining access to typical index funds, because the fund managers there, they work hand in hand with the brokers, and the brokers can introduce you to one that you feel should be okay for you. So get your broker, and your broker will help you to buy the fund you want to buy, the index fund you want to invest in. They can do it for you.